IND AS 7, Statement of Cash Flows, Tracking the Real Movement of Money. Hello and welcome to Candymentor. Today we'll decode IND AS 7, the standard that tells you how to prepare and present the Statement of Cash Flows. This statement shows the real movement of money, and that's often where the true financial story lives. Objective of IND AS 7. The purpose is simple: show how cash actually moved. It gives users insight into liquidity, solvency, and financial flexibility. You'll see how operating, investing, and financing activities generate or consume cash. Good cash flow reporting improves comparability across periods and across companies. Scope and applicability. IND AS 7 applies to every entity that prepares financial statements under IND AS. There's no exemption for small companies or specific sectors. The cash flow statement is a primary financial statement, just like the balance sheet and P&L. So prepare it every reporting period, and prepare it carefully. Key definitions. Let's keep definitions tight. Cash: notes, coins, and demand deposits. Cash equivalents: short-term, highly liquid investments that are convertible to a known cash amount and carry insignificant risk of change in value. Think treasury bills or 3-month deposits. Cash flows: actual inflows and outflows of cash and cash equivalents. And remember, the 3 activity buckets: operating, investing, financing. Structure of cash flow statement. The statement is structured like this: 1. Cash flows from operating activities. 2. Cash flows from investing activities. 3. Cash flows from financing activities. 4. Net increase or decrease in cash and cash equivalents. 5. Reconcile opening and closing cash balances. This order helps users trace how day-to-day operations and strategic moves affected cash. Operating activities. Core business cash flow. Operating activities are your core business money flows. They show whether the business operation generates cash or burns it. Typical items: cash receipts from customers, cash payments to suppliers and employees, income taxes paid, unless specifically linked to investing or financing. If trading securities are your main business, receipts and payments for them are also operating. Investing activities: long-term growth and asset investment. Investing activities involve long-term assets and investments. Examples: purchase or sale of property, plant and equipment, PPE, acquisition or disposal of subsidiaries, loans made to others, proceeds from sale of investments. Interest and dividends received can be investing or operating, depending on your policy. Choose consistently. Financing activities: capital and funding. Financing activities create or repay capital. Typical cash flows: issuing or buying back shares, borrowing or repaying loans, principal portion of lease payments where applicable, payment of dividends. These show how the business is funded and how that funding is returned to providers. Other. 2 methods for operating cash flows. You can present operating cash flows by 2 methods. Direct method shows gross cash receipts and payments: cash from customers, cash paid to suppliers, cash paid to employees. It's very transparent. Indirect method starts with profit before tax, then adjusts for non-cash items and working capital changes. It's more common in practice. Both are acceptable. Choose one and use it consistently. Indirect method, stepwise approach. If you use the indirect method, follow this sequence. Start with profit before tax. Add back non-cash expenses like depreciation and amortization. Adjust for gains or losses on asset sales. Adjust for working capital movements: inventory, receivables, payables. Subtract income tax paid. The result is net cash from operating activities. This shows how accounting profit converts into cash. Cash and non-cash items differentiation. Exclude non-cash transactions from the statement itself. Depreciation, amortization, and unrealized foreign exchange movements are non-cash. Non-cash acquisitions, for example, buying an asset by issuing shares or converting debt to equity, must be disclosed in notes. These transactions affect future cash flows, so users need to see them, even if cash didn't move now. So, interest and dividends, classification options. There's flexibility, but be consistent. Interest received, operating or investing. Interest paid, operating or financing. Dividends received, operating or investing. Dividends paid, financing. Your policy choice should reflect how your business uses these cash flows and must be applied consistently and disclosed. Foreign currency cash flows. Record foreign currency cash flows using the exchange rate on the transaction date, spot rate. Unrealized exchange gains or losses are not cash flows, but show the effect of exchange rate changes on cash and cash equivalents separately at the end of the statement. This helps users see currency impact distinct from operating performance. Income taxes in cash flow. Income taxes paid are generally operating cash flows. However, if the tax is clearly attributable to investing or financing activities, for example, tax on a capital gain from asset sale, classify accordingly. Disclose total tax paid separately if it's material. That's it. Changes in ownership in subsidiaries. When you acquire a subsidiary, present the net cash outflow under investing activities. Purchase consideration, less cash in the subsidiary acquired. When you dispose of a subsidiary, show sale proceeds, less cash disposed. Also disclose the gross amounts and significant components to give users full context. Components of cash and cash equivalents include cash on hand, demand deposits, and short-term investments with maturities of 3 months or less. Exclude long-term deposits, equity investments, and bank overdrafts, unless overdrafts are an integral part of cash management and are reported as part of cash and cash equivalents. Be careful. Classification errors here distort liquidity analysis. Non-cash transactions, disclosure. Non-cash examples, issuing shares to buy assets, converting debt to equity, acquiring an asset with a finance lease. These must be disclosed in notes because while they do not move cash immediately, they affect future cash obligations and financing structure. That's it. Presentation format example. A practical layout for indirect method. Cash flows from operating activities. Start with profit before tax. Add depreciation, finance costs. Subtract interest income and gains on sale of assets. Adjust changes in working capital. Subtract taxes paid. Final line, net cash from operating activities. Then list investing activities, purchases and sales of PPE and investments. Then financing activities, borrowings, repayments, dividends. End with reconciliation to closing cash and cash equivalents. Reconciliation requirement. Reconcile net change in cash and cash equivalents with opening and closing balances. Also, reconcile liabilities arising from financing activities, e.g., new borrowings, repayments, and non-cash changes, to provide clarity on debt movements. This links the cash flow statement back to the balance sheet and explains movement in financing items. End. Disclosure requirements. Required disclosures include components of cash and cash equivalents, reconciliation of cash flow to balance sheet, the entity's policy on classifying interest and dividends, non-cash investing and financing activities, and any cash restrictions like pledge deposits. Clear notes improve usability and reduce interpretive risk. End. Analytical insights for users. Key metrics derived from the cash flow statement. Operating cash flow, OCF, cash generated from core operations, indicates sustainability. Free cash flow, FCF, Operating cash flow minus capital expenditures measures discretionary cash available to investors. Useful ratios: OCF divided by current liabilities, cash flow per share, and the cash conversion ratio, which is OCF divided by net income. These help assess quality of earnings and liquidity. Common mistakes. Watch for these frequent errors: classifying short-term investments as cash equivalents when they are not, misplacing financing cash flows into operating activities, failing to disclose significant non-cash transactions, forgetting to show FX translation adjustments, not reconciling closing balances, which undermines trust in the statement. This. Interaction with other standards. IND AS 7 links closely with other standards. IND AS 1 for presentation rules, IND AS 21 for foreign exchange implications, IND AS 109 for financial instruments and classification of interest/dividends, and IND AS 116 for lease payment classification, principal typically financing, interest operating or financing depending on policy. Cross-check these when preparing cash flows. Numerical illustration, indirect method. Example walkthrough. Profit before tax, 500,000. Add depreciation, 100,000. Interest expense, 20,000. Less gain on sale of asset, 10,000. Less increase in receivables, 30,000. Add increase in payables, 40,000. Less tax paid, 50,000. Net cash from operations equals 570,000. This shows how non-cash and working capital movements convert profit into cash. End. Key analytical ratios. Some useful ratios to monitor. Operating cash flow ratio equals operating cash flow over current liabilities. Shows short-term liquidity. Free cash flow equals operating cash flow minus capital expenditure. Shows cash available to shareholders. Cash return on assets equals operating cash flow over total assets. Indicates asset efficiency in producing cash. Track trends, not single values, to spot strength or deterioration. End. Closing summary. IND AS 7 turns accounting profit into cash reality. Classify transactions into operating, investing, or financing. Exclude non-cash items from cash calculations, but disclose them. Reconcile opening and closing cash, and disclose policies and non-cash movements. Remember, a company can be profitable yet cash poor. The cash flow statement tells you why. Final takeaway. The statement of cash flows is your financial truth teller. When prepared cleanly, it shows whether a company actually generates cash, how it invests for growth, and how it finances itself. Master IND AS 7, and you'll read beyond profit numbers to the company's real financial stamina.